I want to start this week with a number, 75. That's the number of basis points that mortgage rates have climbed since the day before the United States went to war with Iran on February 28th. That equates to 0.75% increase on mortgage interest rates, which hit 6.75% on Tuesday this week, the highest level since July of 2025 and representing the fastest rate spike we've seen since the end of 2024. For a buyer putting 20% down on a $420,000 home, that's $167 more per month on their mortgage payment. It's the war tax. And at the same time, something happened this week that should make every person sitting on the sidelines stop and think about their strategy. So, let's get into it. Pending home sales increased this week, but we're not going to start there. We're going to start with the interest rate story. Rates are up. The median existing home price hit $417,700 in April, the 34th straight month of year-over-year price increases. High rates and high prices. On paper, that's an unfriendly market, as we've seen during parts of this cycle. Then on Wednesday, the bond market caught a break. Newswire suggested that U.S. and Iran were nearing a final draft of a peace agreement, and rates recovered a little bit on that news. By Thursday, rates had pulled back from their highs, and right now they're sitting at about 6.5%, depending on lender and loan type. There are some government loans that you can still get with a 5 in front. One analyst put it very plainly this week. Unless there is a verified peace treaty and oil prices respond in a sustainable way, any dip in rates is not a trend. It's just a pause. The bond market is whipsawing, basically, on every single headline. Who are we going to bomb? Who are we not going to bomb? What is the price of oil going to be tomorrow? What are we going to wake up to? Honestly, that sentence about there not being a downward trend with interest rates again until the war is over is probably the most honest sentence that should be directly translated into every buyer's rate strategy. This is coming from a gambler. I typically like to float my borrowers to edge out any bit of monthly savings I possibly can. Not in this market, no siree. Any dip is a pause, not a trend. I reserve the right to change my stance on this as information changes, but right now, the only thing that would make a rate dip a lasting trend downward would be a verified peace deal with sustained oil price improvement. I'm losing hope on that as a human being, but as a mortgage lender, I'll keep praying. Here's what Mortgage News Daily's chief operating officer, Matthew Graham, wrote this week. Bonds are telling politicians to get serious about ending the war or face increasingly dire consequences. It's interesting that no one was leading with this other news, though. Pending home sales rose in April, both month over month and year over year. And mortgage purchase applications rose 4% last week, 7% higher than that same week a year ago. What in the actual F is that? Rates hit 6.75%, the highest in 9 months, and more buyers applied for purchase mortgages? What is the data trying to tell us here? NAR's chief economist Lawrence Yun reported that agents on the ground are seeing a surge in buyer demand in just the last few weeks. NAR said there are 2 barriers to homeownership right now: rates and uncertainty. The buyers who have been frozen since February 28th are starting to thaw, and I think it's because they've become more confident that certainty isn't coming. Weird sentence, I know, but people are starting to accept that this war isn't going to be quick. And they've already waited years and years to buy. So maybe they're accepting 6.75% as the reality. They've stopped waiting for a rate that feels good and are starting to look for a home that makes sense. That's the confidence tax beginning to lift, even though uncertainty is still very present. This week's pending sales number is the first real data point confirming my hypothesis that 2026 would be your last best chance to break into the housing market. And then there's the housing bill that nobody's talking about. In the middle of the rate chaos and the war headlines, Congress did something genuinely significant this week, and almost nobody in the real estate conversation is covering it. Back in March, I told you to start following the 21st Century Road to Housing Act. Both chambers have now passed a version of this bill twice because on Wednesday, in a 396-13 bipartisan vote, one of the most lopsided votes in recent memory, the House passed this latest version of the bill. Now it goes back to the Senate. Here's what's still in it and why it matters for you. The bill aims to boost housing supply and lower costs. The Senate's version included a ban on large investment firms, defined as those owning 350 or more units, from buying single-family homes. The House amended that, allowing some investor purchases while providing regulatory relief for community banks. The legislation won from support because rental, construction, housing industries wanted them to remove a requirement in the Senate-passed bill that would have forced major investors to sell any units they built beyond the cap within a 7-year window. That last part is controversial, right? The Senate wanted to force institutional investors, the Wall Street landlords that first-time homebuyers have been supposedly competing against, to divest. The House softened on it. That's how the bill passed. Whether the Senate accepts the House version is an open question now. It's not clear whether the revamped House bill will gain the needed 60 votes to pass the Senate. But here's my personal take. A 396-13 vote on anything in Congress right now is remarkable. The political will to address the housing supply feels real, and it feels bipartisan. Whether this specific bill becomes a law is a separate question. Whether it becomes law in a different form entirely is also possible. But Washington finally accepts that the housing shortage is a crisis worth legislating around. For first-time homebuyers specifically, I want you to pay attention here. If the institutional investor restrictions survive in any meaningful form, it removes a perceived barrier. The barrier is frustrating structural disadvantages you have been told you're competing against. Cash buyers with algorithmic bidding strategies who don't need to qualify for a mortgage and don't care what interest rates are. But I'm saying perceived here for a reason. Institutional investors currently only own 3 to 5% of the total single-family housing stock in our country. The thing is, and this is real, they had dedicated significant portion of their funds to rapidly increase that share. They were allocating a large amount of their funds to buy real estate for the last few years and for the next few years. So it could very well be a win in terms of competition. Again, if it passes the Senate. What this all means right now? 3 things happened this week that really, really matter. Rates hit their highest level since July and then pulled back a little bit on peace deal hopes. We have a new strategy though. We lock your rate as soon as you find a home because the bond market is not friendly right now. Pending home sales rose and purchase applications jumped 7% year over year. That influences our strategy when it comes to getting very serious about finding a home you can make the numbers work on. And then Congress passed a landmark housing bill, 396-13. But the honest read there, it's not a law yet. Senate still has to reconcile. There could be a totally different version that's created again. It's a nice vibe check on housing being important, but it doesn't influence our strategy yet.